Okay, so today we are going to look at Nahara and the Fugae core. So this question is to do with acquisitions and mergers. So probably shall look at some of these aspects that normally come up in this question, and I hope you remember from the notes that we did. As you said, you normally have to first go to the requirements. And again, this is section N number, so it carries 50 marks. And the first question is asking you to discuss whether or not Nahara's acquisition strategies pursuing diversification and purchasing under this candidate. So, of course, as we said, for theory, you either know it or you don't. So, and if you know it, you can always just start with this one and get all these marks right away. We shall discuss as we go. Then the part of the report. So where they want you to prepare a report to the board. So I know that you are aware how we do the report from yesterday's question. And what they want you to do here is to estimate the additional value quoted for AFM if it acquires Fugae before you consider the luxury transport project. So you know there is going to be some acquisition. AFM is going to acquire Fugae, and there is also some luxury transport project. So you get that one when you read the material from the exhibits. Then also estimate the additional value of the luxury transport project. So you do it before for 10 marks. Then you look at the value for this project for 18 marks. And then you evaluate the benefit attributable to AFM and Fugae, combining the two companies. So you do that both with and without the project. And then you conclude whether or not the acquisition is beneficial. Of course, they're saying you should also list the assumptions that are made. So, ideally, the first two parts, if you do them right, then the third part is just about combining what you have done in those two parts to decide whether it is beneficial. And then you put the assumptions. Of course, there are 2 marks for communication, which you get by writing a good report, analysis and evaluation from your appendices as you purchase them, skepticism, questioning the facts that are given to you, and then some commercial acumen, like knowledge of the business. So if we now go and look at what we have for the materials, for the scenario itself. So it's quite a mouthful, but of course it's about an acquisition, like we said. I hope you read through before, but if you didn't, it's okay. We are going to go through. So Nahara, okay, that's nice. So Nahara is privately owned. So now, the difference between this company and what we saw yesterday when the company is listed is that you won't have information concerning its valuation on market value terms that is substantial. You won't know some share price. So there are some things that you want to know that are not provided for you for the same company. And here, it is owned by the government of the wealthy or rich country to invest in sovereign funds. So although it is a private company, it is owned by the government. So it has followed the strategy of risk diversification for a number of years. Now, this is one of the questions they're asking us in the first part, risk diversification. So remember, when you looked at risk, we said that there are some risks that you can accept, that you say, okay, these risks, I cannot avoid them, but they are also not so severe and probable, so I can accept them. Then there are those risks that you say, okay, this risk is severe and very highly probable, so you try to avoid that activity altogether. So there is also diversification whereby, especially if you are looking at business risk, if your company is risky because it is operating in maybe in a hospitality business, then you can now acquire other companies that are not doing hospitality business, so that you have different business areas that can sort of balance each other in terms of the risk. So that is diversification. So, and how does it do it? It acquires companies from around the world in different sectors. So when there has been a problem in one of the countries, they are still okay. When there has been a problem, maybe in one of the business sectors, they are still okay. However, here, this is one of the points that we are going to make. Normally, shareholders don't like it. Shareholders don't like it. And the reason why they don't is that shareholders normally want to diversify by themselves. So, when you have a company that is dealing in many different things, now like this company is acquiring many other companies that are in different countries and they are different sectors, there is that lack of specialization.
True.
The company is specialized very well. It can be able to hone in its skills and be able to maximize shareholder wealth in that sector. So shareholders normally think if they wanted to diversify, they can buy other shares by themselves of different other companies, as opposed to you doing it for them. Okay, so that's one of the points that we can make. However, of course, it's beneficial for the company when there's that diversification, because the company is actively now involved in the risk management that comes with the business, so that in case some of the products are not working out, the others can keep it afloat. But now the problem is that the ones that are keeping it afloat are not going to be maximized because there's another negative from the other side. That's what shareholders don't like. So we are going to talk about it more. And then one of the acquisition strategies that they use is to identify and purchase undervalued companies in the airline industry in Europe. So this is one of the things they're asking us to say whether it is valid, because now, when they say a company is undervalued, it means that the share price does not reflect the true value of that company. For example, you can find a company and it's valued at 50 million on the market, by the share price $50 million, and yet if you look at its business and the prospects that are coming and all those things, it actually is 200 million. So usually some people look out for such companies and buy them and they turn them around. But the thing is, if you consider that shareholders who are valuing this company at 50 million have information that is available for them, which is being published. So what are the chances that they can all be wrong to that extent and undervalue a company to that great extent? So it's not very likely. They are going to be just, the reason why it will happen in most cases is that maybe insider information. Somebody knows something that no one else knows. Then they can say, okay, this company, maybe it has just discovered some revolutionary way of doing work, and it's not yet valued in the share price, but once it is found out, the share price will increase. So that is one of those situations. But in most cases, if a company is valued at 200 million on the stock exchange, there's going to be a slight difference in the actual value. So it means that if you keep on doing this acquisition of looking for undervalued companies, you may risk buying companies and then you end up not getting any value from them.
Because they're actually not undervalued to the extent you expect.
Exactly.
But quick question, is there a benefit to companies actually being undervalued?
For the companies themselves? No, it is normally beneficial for the acquirer.
Mm.
So yeah, because for you
So
now,
acquire
like,
it for less.
yes, they acquire it for less, and then they are able to realize its actual value, because once they acquire it, they now do these investments here and there, and then before you know it, the share price catches on.
Okay.
Yeah. So they have acquired this company, Fugae, but it repairs and maintains aircraft engines. So now, a few weeks ago, it started intention to pursue the acquisition of an airline company based in the same country as Fugae. Now here they are looking for an airline company, because this company maintains and repairs aircraft. So, but they want to get also an airline company. So the EU, concerned about this, has asked Nahara to sell the Fugae before pursuing any further acquisitions in the airline industry. So apparently the EU may not want monopolies, because if you have a company that repairs, maintains aircraft, but then you also own an airliner, and probably you own another thing, you find that you are going to be concentrating almost all your energy in that industry, and you may monopolize it. So the EU doesn't want you to do so. So they ask you that if you want to acquire this company, you need to first sell Fugae. So, and now that's why AFM comes around and it wants to acquire this company, Fugae. So this is where we are going to cultivate. The first parts are going to be for answering basically that theory part A. Now the acquisition itself is where we are going to now do the computations. So this company, AFM, is a company specialized in producing and servicing business jets. So it wants to acquire Fugae for $1.2 billion. So Nahara wants a premium of 30% on the equity value of Fugae if it is sold. This is very important information to remember. When a person is selling their company, they normally don't sell it to you at the fair market value. Because then, what is the purpose of them selling you at the fair market value? So they end up asking for premium, and in financial comes out to be like goodwill. But here in financial management, we are trying to look at, first of all, how much do you think they are going to, because they want to buy it for 1.2 billion. Now, but these people want to get a 30% premium on the equity value of Fugae if they sell it. So the question is going to be, is this 1.2 billion enough to cover for the market value itself and also this premium? So we shall see. Now we have information about the financial position of the two companies. So of course, AFM is bigger in terms of share capital, even in reserves, everything in every aspect. Okay, it's much, much bigger. So we have been given share capital, reserves, the liabilities, both current and non-current, and then they have given us total capital and liabilities. So here, what we normally are going to be looking out for is the market values, because these are book values, but we can convert them to market values given what we have. Need equity, we need debt. So the equity is the share price, and the debt is going to come from the non-current liabilities. So let's read on and see what they want us to do. So each share of AFM is currently trading at 7.5. So when you are given the share price and you know how many shares you have, then you can get the market value of that equity for the company. Okay, and it's a multiple of 7.2 of its free cash flow to equity. Shall see how that works.
I don't understand that. I read it and it didn't make sense.
The free cash flow to equity.
Mm.
Okay, now, remember when we talked about the free cash flow? The free cash flow can be free cash flow to the firm or free cash flow to equity. So free cash flow to equity, because when you look at the company's cash flows, you look at the revenues and the costs. So basically what you are looking at is how much money, because remember when you get the revenues, then you remove the cost, then you pay the interest expenses. Now what remains is what you're going to pay to the shareholders after removing the reinvestment.
Mm.
That is called the free cash flow to equity.
Okay.
Now, on a share basis, if you are looking at it on a share basis, the free cash flow to equity, let's say it is, because this is 7.2 times that free cash flow to equity for each, for if you look at it on the share basis. So which means that you can utilize this information to determine what's the free cash flow to equity for this company, AFM. Because you know you know at 7.5 is equal to 7.2 times the free cash flow to equity. So you can now determine what's the free cash flow to equity by dividing. Okay, so that is one of the ways we may use that figure. Or it may just help us to know how big this company is performing in terms of its share price. So we shall, normally that depends on what you find in the question. I'm saying we are going to utilize it for that first purpose. So now it expects that the combined value, total cash flow of the combined company will increase by 40 million with synergies. So now you see that this 7.2 times the free cash flow to equity is going to give us what's the free cash flow to equity that we have now, and it will increase by 40 million if we combine the companies. Because when you are looking at acquisitions, normally you look at before
And after.
and after. And for the before part, you look at both companies, the acquirer and the target. Then for the after, you look at the combined companies. Then you look at the synergy that comes from there. The synergy here will mean that if each company had a value of 5 million, when you combine them, the total value is like 12 million, which means that the synergy there is 2 million. So that's what you'll be looking out for. So after adding the synergy benefits of 40 million, so they have told us that the synergy is going to be 40 million. So when you are being skeptic, here's where you may talk about it. You say, okay, but this is only possible if the company was grossly undervalued. Or if they are, synergies can be from the fact that the company was undervalued, or it can be because now you have some cost synergies like economies of scale and scope, removing redundancies, such things that can help you reduce all the total cost. Now, of course, you have to determine whether that is true, but you may discuss it when you are being skeptic about whether it is possible that that's going to happen. And the multiple now is going to expected to actually be 7.5. Right now it's 7.2, but now it may become 7.5 after you add the synergies. So, and they have given us the free cash flow to equity of Fugae is 76.5 million, and to generate return on equity of 11%. So return on equity normally is going to be revenue, or you can look at it at, because when you are looking at return on assets, you are looking at revenue divided by assets. So here, when you look at return on equity, you look at revenue vis-a-vis the equity that you have. So now, over the past few years, it has been returning 77% of its annual free cash flow to equity back to Nahara, retaining the balance for new investments. Now, Yeah, I don't know if you are able to see what that statement is going to help us with, but you see, when you go to the formula sheet, let's go to the formula sheet. There is this formula here. This one, Gordon's growth approximation. So it can help you determine the growth in dividends or the growth of the free cash flows for a company. And it utilizes the amount which has been retained, which is B, and the cost at which you are reinvesting it, which is RE. Because the idea is, so this one is knowledge that comes from FM, but we also looked at it when we are looking at the notes of how to determine growth. So if a company makes profits of 5 million and they give all of them to the shareholders, then they don't have any money to invest, so they may not grow. So the assumption is the more retention you make, the better you grow, because what you retain, you now invest it to get more return. So that is where this statement comes in, because they are saying that Fugae has returned 77.3% of its annual free cash flow to equity to Nahara over the past few years, retaining. So if it's 77.3, they are retaining 22.8. So that's what we are going to utilize to see how growth is coming about. So we shall see how that comes to, if you don't see it for now. Then the non-current liabilities are 1,000 nominal value bonds, which are redeemable in 4 years at nominal value, on which the company pays a coupon of 5.4. So the debt is B plus, and the credit spread on B plus is 80 basis points above the risk-free rate. So this can help us determine the cost of debt and also the market value of debt. So because they have told us how many, what's the nominal value of the debt that we have, and when is it redeemable, and then also the spread, the coupon which is being paid on it. So that is something that's going to help us. So information that we have here is basically going to be enough to determine the valuation before this luxury transport. But let us also look at the luxury transport before we do the computation. So in recent years, they are saying that the country where Fugae is based, has been expanding the tourism industry, and they want the industry to grow significantly in the near future. So right now they travel using public transport and taxis, but they are looking for luxury travel. So if it expands, then the demand for luxury travel will grow, and we are trying to look at entering the market through a 4-year project. So project will cease after 4 years because of increasing competition. So this is some small NPV computation that I suspect is coming. So, and they've given us the initial cost, 42 million, and these are the following after tax cash flows. So they didn't want you to do another NPV of saying revenue, cost, and all that. They gave you the cash flows after tax, and they are based on the expansion as expected. However, there is a 25% chance that tourism will not grow as expected in the first year. And if that happens, then the project NPV will be 50% of the original estimates over its 4-year life. So that is now bringing in risk, because when they say that there's a chance that growth is not going to grow as expected, then it may be something. Then, even if it grows as expected in the first year, there is still another chance of 20% that it will not grow in the second year as expected. and therefore the present value of the project's cash flows would then be 40% original estimates in each of these years. So that is going to be utilized for determining the NPV of the project. So there is another company, which is Lumi, which has offered 50 million to buy the project from Fugae at the start of the second year. So Fugae is considering whether having this choice would add to the value of the project. This is what we call real options. And it uses the Black-Scholes option pricing model. Remember it from the notes?
Yeah, I remember.
Yeah. So the good thing is that for now, for when we are doing this paper, you no longer have to go through the process of calculating all these things. There is a calculator that we shall see. You just need to know what to feed it, and then it will give you the figure. So if the project is bought by AFM after the project has begun, project will not result in any additional synergy benefits and will not generate any additional value for the combined company above any value the project has already generated for Fugae. So the synergies that they are discussing, if the project is sold, there won't be any more additional synergy. So you have to consider whether you need to sell, and then the effect on those cash flows. Although there is no beta for companies offering luxury forms of travel, there is another company called Reka, which is listed and it offers passenger transportation on coaches, trains, and luxury vehicles. 10% of the business is luxury transport market, and equity beta is 1.6. So this information, if you read it now, you can start seeing what we did yesterday. We have been given a proxy company, but it deals with more than one thing. So we have been told that the luxury part is 15%. So we need to determine the asset beta for that part. And they are saying that the asset beta for the non-luxury part is 0.8. So we shall get the asset beta for the luxury part. The shares for Reka are right now at 4.5 per share, and the debt is 105 per 100. Then we have 80 million shares in issue, and the book value of the debt is 340 million. So we have information for the market value of equity, market value of debt. And they have told us this time that debt beta is 0. And we said yesterday that even if they don't tell you, you can put it in your assumptions that debt beta is 0, so that you don't do the whole computation. So now, of course, the tax is 20%, and then risk-free rate is 4%, premium 6%. So now we have read through everything that we need to do. So as usual, let us skip to the computation part, then we shall come back and look at these discussive parts so that we save time. Now, this question requires you to be very, very careful how you organize your computation so that you don't spend so much time trying to figure out how to do what. Now, as we said, for acquisitions and mergers, what we need to do, determine the value of the companies individually before the merger, then determine value the combined company, and then from there determine the synergy. And after getting the synergy, you can determine the value of the value change. Let's say value change for the shareholders of the acquirer and the target. So here what we mean is that when the synergy is being calculated, it's not going to go to only the acquirers, because the target people, there's people who are selling you the shares also. When they sell when they sell the company, when they become shareholders or when they get money, they have some gain. So you are looking at the value change, which is normally going to be a gain. I just wanted to make it specific so that it can be a loss as well, but let's say it's a gain. So this is normally what you follow when you are doing it. So what we are going to do is to determine the value of those companies individually. So what we are going to first start with, because remember we are doing appendices. So when you look at the question, the first question asks us to determine the value created, additional value created for AFM if it acquires Fugae. So here they didn't ask us to look at even for Fugae. They wanted only looking at for AFM. So let us start with that. So Appendix 1, additional value created for AFM before the luxury transport. So we need to determine the value of AFM and the value of Fugae. So what is the value of AFM? So to do so, we are told we are given information about AFM. Okay, the share price 7.5, and then we know how many shares we have. So we need the market value of equity for AFM, and how do we get number of shares? We normally get the 800 million. Okay, 800 million divided by 50 cents, because it shares 50 cents. So before I do anything, this is just how many shares we have. So we have 1.6 billion shares. And then I can now multiply that by the value per share of 7.5.
Did you change the cents to dollars?
Yes.
Yeah.
50 cents is 0.5.
Okay.
Yeah. So that gives us 120 billion. Now you can choose to work in millions, because everything that has been given to us is in millions, right? So let us work in millions. So we are going to work here in millions. So we are going to put here millions. Once we do so, means that we can remove some of these 6 zeros. So that is 1.2 billion. Remember, we are working in millions, so don't forget. So now, and they told us, remember that thing that we read here, that the share price is 7.5, which is a multiple of 7.2 of the free cash flow to equity. And I told you that if you want to get now the free cash flow to equity, I will have to divide. Okay, so to get the free cash flow to equity, so I'll just get this figure, then I divide it by 7.2. So that's why we have that figure there, that statement of the 7.2 as a multiple. Okay, if you want, I can write it here, how we came to that conclusion.
It's okay, you can write it.
Okay, so we said that the market value of equity is 7.2 times the free cash flow to equity. That means that to get the free cash flow equity, you get market value of equity divided by 7.2. So that's how we get to that division. Okay, is that now clear, that statement?
Yes.
Yeah. Okay. So we can now proceed. So after getting that market value, free cash flow of AFM Co. So if you read through and you see now what they said, so they're saying that there's going to be some synergy because now we want to see, because this is the value of what? Of AFM Co. And this is the free cash flow to equity for AFM Co. If you want to get the market value of debt for AFM Co, you still can use the non-current liabilities here, which we are going to do. But then for Fugae, they told us that the free cash flow to equity right now is 76.5. Okay, which gives us 11% return, but it has returned 7.3. So because Fugae has been returning this portion, remember I said that we are going to calculate the growth because they have given us the current free cash flow. But what we are going to be interested in is what is the future, because to value a company, you normally value it based on the expected free cash flows. So we are going to have to determine what those free cash flows are. So we are going to start with determining the growth rate. So for Fugae, we are going to determine the growth rate. You can use the Gordon's growth model. You don't have to write it here, but when you are writing the part where you go to the Word document and say what you've done, you may have to mention that the Gordon's growth approximation was utilized, determine the growth rate. And we said that it is given as B times RE, where B is the amount retained, and then the RE is the cost of equity. And then you need to just find out if they have given you. So they have given us return on equity of 11%. So that's what we are going to use. So we shall have to multiply 11% multiplied by, I told you that if they are returning 77.3% to the shareholders, they are returning 22.8. 22.7. Okay, so 22.7%, which gives us a growth of 2.5%. Okay, so having determined that, then we can now use the
growth. Let's first go back to that question. Just
okay.
as a question. Oh, it wasn't. Okay, it's okay. It's okay.
Okay. Now, after getting this growth model, then there's another formula that we can use, the one just above it, the growth model itself, where if you want to determine the market valuation, determine the free cash flow, which is the dividend, because the dividend approximates the free cash flow, or the free cash flow approximates the dividend, because we said it is the money which is available to be given to the shareholders, which is normally the dividend, if you choose to give it all to them. So we are going to use this formula here. So let me just take it so that we can see it very well. So to use it, so now we can say market value of equity of Fugae is going to be the dividend, which is the free cash flow to equity, like we just mentioned, and it is 76.5 million multiplied by 1 plus the growth, which is here, divided by the cost of equity, which we are using the return to equity, 11%, minus the growth.
So the entire time, we're just getting the growth rate to use in that formula.
Yes.
To determine, okay, the market value.
So which gives us 922. Okay. Remember, we are working still in millions. If
Millions.
yeah, if you want, you keep on putting it everywhere. Okay. So that's 922 million. That is now we have the value of AFM. We have the value of Fugae. Now we need to determine the combined value of the company so that we can see if there is some synergy. Yeah. So for the combined value, what did they tell us? They told us that the total free cash flow of equity of the combined company will increase by 40 million. Okay? By 40 million because of synergy. And they say that after that happens, the multiple now will become 7.5. Which means that now the combined company, we shall have the value of the free cash flow of AFM plus the free cash flows of Fugae, which was 76.5, plus the 40 million, because they say the free cash flows will increase by 40 million.
40 million.
Plus the 40 million. And if you have all those things and you multiply them by the multiple now, 7.5. Okay, because remember, to get the share price, what we are doing is that we are multiplying the free cash flow to equity by 7.5 now, because the ratio has become 7.5 now. So multiply that by 7.5. Okay. Now, this is the value, but this value is not going to be exactly the only value that we are going to consider. Okay. So this is the value of the company in millions again. Okay. This is the value of the combined company in millions. Now, how do you determine synergy? What you do, you say value of AFM for then the one of Fugae. Then you look at the combined company, or you can actually first sum these up. So if you look at the one of AFM, is that one. If you look at the one of Fugae, is this one. When you combine them, you get 12,922. But the one of the combined company is 13. So you see now that there is some gain.
Yes.
The gain, okay, that is the synergy. So this is the synergy benefits. So now this is the synergy benefit, 452 million. Now the thing they told us that Nahara will have to receive a premium of 30%. Okay.
Sure.
Yeah. So gain to Nahara is 30% premium on the market value of Fugae, and market value of Fugae is 922. So for it to gain 276.64, which means that the other one, it means that AFM will get the remainder. So this is the synergy, but Nahara is taking 76 of it. So now the gain to AFM is going to be 452 minus 276. So it will get 174. Okay. These are all millions. So this is the additional value that the AFM will get by actually buying this company. Yeah. So that is the first appendix. So second question wants us now to look at the additional value of this luxury project. So now that one, we are going to determine, because remember they told us it's going to be this project, these are the cash flows, but it's not as simple as just coming and now getting the net present value, because they told us that there are some chances that the cash flows won't be like this. So therefore, we need to determine the cash flows by putting in that aspect. But another thing is that this business here, we don't have its cost of capital. So that's why we have these proxies. We have this company called the, they said that although there's no better, yeah, here, although there's no better, but we have this company called Reka, which is dealing with these other things, but also transportation for luxury people. So 15% of it is the luxury part. So we are going to need to determine, so for appendix 2, so you can label them normal numerals or numbers, that's okay, but be consistent. So here we are going to look at, you can look at the value, because they told us to determine the additional value of the luxury transport project, okay? Of the luxury transport project. So, but before we do so, we need to determine the cost of capital that we are going to use. So we can determine the cost of capital for the transport, for the luxury transport project. So we start with what we know. We know for Reka, Co, we know that it has equity beta. So beta equity 1.6. Then we know the asset beta. Let's first leave that part. We are going to come back to it. The shares, 5.4 per share, and it has 80 million shares. So we can get the marketing value of equity. 4.5 times 80 million. Okay, that is 360 million. Don't have to work in millions if you don't want, because this is another appendix. It's okay. However, it depends on, I think it may make sense to work in the same accuracy.
Yeah.
So that we are able to just talk about figures without having to worry where if we are dealing with millions or rather or not. So that's 360 million. That's market value of equity. And then market value of debt, it has there 105 per 100 and it has 340 million. So market value of debt, just make this debt. So what you do with this, you have 340 million divided by 100 because they are quoting it as 105 per 100. So divide by 100, then multiply by 105. That gives you the market value. So although the book value is 340, because they are trading $5 over the normal par value, so you end up with 357 million as market value of debt. Tax is 20%. Now remember what we are going to use as the formula. So if you want, you can bring it here so that it can help you pick things that you are looking out for. We are looking for the asset beta formula, but we only need this first part, okay? Because the beta of debt is 0.
Yeah.
So you can now, so if you look at what we have BE, we have VE, we have VD, we have tax. We have everything to get our BA. So BA is going to be market value of equity divided by equity plus debt multiplied by 1 minus T, everything multiplied by beta equity. So that gives us 0.892. Okay, so after getting that, remember this is the asset beta, but it is for RECA, and RECA is not only dealing with luxury transport. RECA deals with it offers passenger transportation services on coaches, trains, and luxury vehicles. Yeah, so if we want, so this is I'm going to put it luxury and non-luxury. That we know that this is for both luxury and non-luxury. But we note the beta asset for the non-luxury. They have told us that what is it? Asset beta of non-luxury transport is 0.8. 0.8. So remember what we said yesterday, that if you are looking at the beta asset of the whole company, it's got to be beta asset, and I'm going to say of the luxury multiplied by the luxury proportion plus the beta asset, the non-luxury multiplied by the non-luxury proportion. So yeah, which means that this 0.892 is equal to 0.8 multiplied by, because what's the part which is luxury? 15%. So the other part, 85%, non-luxury. Which means that if I write it here, I will say 0.892 is equal to 0.8 multiplied by 85. Okay, let's start with let's follow the formula as it is. Beta asset of luxury multiplied by 15% plus 0 multiplied by 85%, which means that I can get the beta asset for the luxury. Okay, we said yesterday you first get 0.892, then you subtract 0.8 times 85%, then everything you divide it by 15%.
15%.
Yeah. That gives us the luxury beta asset as 1.41. Okay, so having got this beta asset, You know the risk-free rate. Where is the risk-free rate? 4%. So the risk premium, 6%. Then we can use capital asset pricing model. Okay, just to bring it. Some of these you'll be knowing them without even looking at them, although you have them in the formula sheet. Okay, so yeah. So now we can get the cost of equity, okay, for the luxury, which will be risk-free rate plus the beta multiplied by the risk premium, right?
6%.
Yes. But now, this is if you are going to determine like the one we got yesterday of when you are looking at without the gearing part. But this company we are dealing with, Fugae, it does actually have data and all those other things. So we can determine the cost of equity. So we are going to have risk-free rate plus beta. But what you want to do is to get this beta. This beta is asset beta. You want to get its equity beta before you can utilize it here. Okay, because when we are dealing with investments, except for yesterday when we said that we are going to first do all equity finance, we normally deal with equity beta in the capital asset pricing model, like I said. So for us to get that, we shall need to gear this beta asset. And how do we gear this beta asset? We need to determine the market value of equity, market value of debt, then we need to get E, need KD, okay? We are going to, no, we don't need those ones. We need, because we are using this formula here. So market value of equity, market value of debt, need tax and need BA. So tax we already know, and BA we know. BA is 1.41. Tax we have 20%. So what's the market value of equity? So remember this company that is having this situation is, we are going to use the market value of equity for Fugae. Okay, because it's the one that will be doing this luxury transportation. So the market value of equity, we already know it is 922 million. We got it already up here. Now the market value of debt. So they told us about Fugae. Yeah, they say that Fugae's non-current liability is 100%. They are only 100 nominal value bonds which are deemable in 4 years' time. So, and then they said that the debt is rated 5 at B plus and it has a spread of 80 basis points. So we need to determine the market value of debt and the cost of debt. But we can start with the market value of debt because that's what we need right now. Now, for that, what we are going to do, so we can put a working here so that we don't have so many things going on in that working. So we are going to determine market value of debt for Fugae. So what we're going to first of all need is KD. And KD, now how these risk spreads work is that when they say that you are, you know, the credit ratings that the banks are given and other credit agencies, whereby they say that you are triple B or double B or A plus, depending on your ability to pay your debts on time and all that. So how they normally use it is that they will start from the risk-free rate and then they add these basis points based on your what? Your credit spread or your rating. So now here we are going to start with the risk-free rate, and we add 80 basis points to get the cost of debt. Risk-free rate is 4%. Then we add 80 basis points. Number 80 basis points, we said it is 0.08% or 0.8%. So if you forgotten how to do it, you just get 80 divided by 100. That gives you the percentage. So, but it's supposed to be percent. So what you get is 0.8%. So if you want to not put the percent again, you just say divide by 10,000. So if you divide the basis points by 10,000, it gives you the percentage right away. So that gives you 4.8. Now, when you want to get market value of debt and the debt is redeemable, they will give you the redeemable. So redeemable in 4 years' time at par. So what you do, you say in year 0, you have your, because to get market value, we need to determine the interest cash flows that are coming in. So in year 0, or rather year 1 to 4, you get interest. Then in year 4, you get redemption. So now in year 1 to 4, so the cash flow for interest is going to be the coupon rate, right? Which is 5.4%. So if you are doing 100, that is 5.4. That's the interest per year. Then redemption is at nominal value, and we are redeeming it at par. Okay? When they say nominal value, the same thing as par. So we are redeeming exactly 100. So this is how the cash flows can be put. Now, the cash flows that we are putting here is not for the entire figure, because remember the figure itself is actually 30 million. But you don't need to put the entire 30 million here when you get market value per coupon. You can just use 54 and 100. I mean 5.4 and 100. And what you can do, you can say, assuming $100 nominal, but we don't have to assume because it was already told to us here. So then what we need to do is get the discount factors, and we are going to discount them at 4.8. Okay, this cost of debt. So year 1 to 4 is an annuity. You can go to the tables, but you can just put it here. Power minus, so it's for 4 years, divided by 4.8%. So that is 3.562. Then normally we show it in 3 decimal places, so we can reduce them. Then redemption is just at 4 years, so 1 plus 4.8%. Power minus 4, 0.829. Then we can get present value as a product of these two. Then that gives us the NPV. Which gives us 102, okay, 0.14. So after that, we can now get the market value of debt. Market value of debt is going to be, now remember that the total figure is 30 million, right? So you get 30 million divided by 100 and multiply by 102.14. to get the market value, which is 30.64. Okay. So are we okay there?
Yeah.
Yeah. So after getting that, now you bring it here. At 0.64. So after that, now you can get, because now you have market value of equity, debt, tax, beta A. Now you can get the beta equity. This is for the luxury project. So now you use the same formula, but now you are now finding beta equity. So it means that you are going to multiply beta asset by the reciprocal of this figure here. So you start with VE, VD minus 1 minus T divided by BE, then multiply by BA. So market value of equity plus debt multiplied by 1 minus T divided by market value. But okay, there is something that I've remembered we have not done. When debt is redeemable, that KD that we get here, the 4.8. No, it's okay. We can do it like that. So market value of equity plus market value of debt multiplied by 1 minus T. I was confusing something. So then you multiply by BA and you divide by market value of equity. So you get DE as 1.45. Yeah, I was thinking I've done a mistake somewhere. The debt that we are supposed to take is not 30, is 380, the long-term debt.
Yeah, the long-term debt.
Yeah, the long-term debt. So here is 380. Okay, so which gives us the beta equity as 1.89. So after getting now that beta equity of 1.89, now we can come here and find the KE. So the KE we are going to get is going to be risk-free rate plus the beta multiplied by the risk premium, which gives us 15.35%. Okay. If you are going to use tables, you can round it to 15. Because if you take decimals and you are using tables, then you won't be able to get figures. So after getting that, now we can now get because this is KE, okay? So, but remember this project is not only equity financed, so we are going to need to determine the work for this project, okay? Now to get work, we have the formula here. So this is why this part here was having more marks than the first one, because it has, as you can see, it has a lot that you have to follow along, and practice makes you realize what to do. But of course, you need the practice before you can reach that point. So to get the work, you need the value of equity, which we have, need the value of debt, which we have, need KE, which we have, and we also need KD, which we have, and tax. So we can determine work. Yeah. So how to determine work? So since we have value of equity, this part here is the same. So I'm going to do value of equity, which is 922 multiplied by KE. Then I add value of debt multiplied by KD, 1 minus tax. Okay. Then divide by value of equity plus value of debt. So which gives us 12%. Okay, or 11.9, but as we said, if you're going to use tables, you round off. So this is the work that we are going to use. And after getting that, now what follows next is to determine the values, the cash flows that we have been given. So we are given these cash flows. Ideally, it should be now very easy from here, if not for these probabilities of something not occurring. So we can start by looking at the cash flows the way they are given to us. So let us put those cash flows. And we are working in thousands. That's what they have given us. So we are going to work in thousands. So we have the years here. 1, 2, 3, 4. Then we have the cash flows 3277.6. Then we have 16134.3. Then we have 36504.7. And then 35683.6. Those are our cash flows. Then from there, we can get the discount factor at 12%. This is the rate that we have been doing. And let me just round off also. Although since me, I'm going to just use the formula 1 plus this percentage power minus n, which is what I advise. I will still be using a rounded off figure. I will still use the original figure without rounding. But that's what you get also from the tables. If you take 12%, somewhere around there, then I can now get the present value, which is the cash flow multiplied by the discount factor. Now, if I didn't have those probabilities, what would be next is to get NPV. But now I do have those probabilities. So now, what the probabilities were saying that there's a chance 25% that the tourism industry will not grow as expected in the first year. So if that happens, then the cash flows will be 50% of the original estimates. So that's the case, because this is the present value of the first year. Okay. So, and if the probability doesn't grow as expected, then the cash flow of the projects of the 4 years will be 50%. So the 50%. Let's look at scenario 1. If we have if the cash flows, the industry doesn't grow in the first year, we shall have the present value of 4 years, but 50% of them, that's what they said. So 50% multiplied by the present value, the 4 years. So that will be 32.
Shouldn't we be adding the probability aspect, that 25%?
Yeah, we are going to bring it there. We are going to bring it somewhere.
Okay.
I'm just getting the figures, but we are going to bring the probability. Then they say that even if they grow in the first year, then they may not also grow in the second year. And if that happens, then the present value of the cash flows of the investments in each of the years. So that means that from year 2 to 4 will be now 40%. So if industry does not grow in second year, so now it will be 40% of present value for years 2 to 4, which is 40% of the present value from year 2 to 4. So now, how you think about this is they are like, this one is better to be drawn as a tree diagram, although we can't do tree diagrams in the exam. But let me just illustrate what happens. So we are here, year 0. So at this point of year 1, there's a chance that the industry grows. It can grow, in which case the other thing, the NPV, present value of the years, is going to be all of it without having to put 50%. But if it's not, then we shall have 50% present value from year 1 to 4. So the chance of not growing, they said it was how much?
25%.
25%. So this is 25%. And this one now becomes 75%. So
Are you doing something? Because I'm not seeing. It's like you're doing something on the
Oh,
Excel.
you're not seeing?
Yeah.
I wonder why. I don't know if that happened several times, because even last time I was writing and some people were not seeing. So okay, so let me I was doing a tree diagram, but it seems if you're not seeing it, are you seeing what I put there right now? That X.
No.
Okay, let us now just do the illustration without the tree diagram. So 25% chance there's no growth. Therefore, NPV will be 50% of the present value for years 1 to 4. Then 75% growth and NPV. Then there's also going to be 2 chances here. Either there's no growth in second year, in which case now it becomes, and that was what, 20%?
Don't recall.
Let's see. Yeah, 20%. And that means that that's going to be 40% of the present value from year 2 to 4, or 75% growth, but now the other 80% chance of growth in second year. In which case we are going to do 100% present value, right? for all the years. Which means that for you to determine what is the expected value, you're going to say, so expected NPV, you're going to consider the first aspect of 25%, okay, and 25% where there is no growth, right? And there, we do 50%, which we determine is 32. Then, now you consider the 75%. 75%, now you can consider the first part where there is no growth in the second year, and that chance is 20%. Okay? And the way it's going to work is that if it's 75% that there's growth, there's going to be two aspects. In one of them, the first year, because remember, on this 75% now, the first year is guaranteed that there's been growth. So you start from there. Yeah. Then the second year now, if there is no growth, then that chance is 20%, which means that you have 20% times the present value from year 2 to 4 at 40%, which is this 24. Okay. I don't know if you're following.
Yeah, I'm following.
Okay. So there's that part. And then, of course, if that's the case, then the other part that we are going to have is going to be still 75% chance has occurred. But now there's been growth in all the years, right?
Yes.
So you can now just sum up these ones. Okay, which gives you 62. Let's see, I may have missed some part. Yeah, there is that 80% that I missed here. Okay, which gives us 52,699. So that is the expected value. Now this is not expected NPV, this is the expected present value, because we have not yet looked at the cost. Remember, they told us that this is going to cost us 42,000. So expected NPV will now be this one minus the cost 42 million, so 42,000. So you end up with the about 10 million. Remember, we have been working with thousands, so it means with about 10 million. This is the additional value. So now the question asked us for what? Evaluate the benefit to AFM Co from combining the two companies with and without the project. Okay, so we already got the benefit of combining the company when there is no project. So now we need to get the benefit when we consider the project. So what we are going to do, of course, then we are going to look at, because there is that thing that they also told us, because remember they told us here, okay, this was not, it's there in the scenario. They told us that this company, Lumi, okay, Lumi has offered 50 million to buy the project at the start of the second year. and we need to see whether that is going to benefit us. So now, remember the scenarios that we have looked at here. We have said that there is a chance that a 25% chance that there's no growth in the first year. If that happens, it may make sense for us to actually sell the project for 50 million. Okay?
Yeah.
So it may make sense for us to sell the project for 50 million. So, and that 50 million is given to us, they said, at the start of second year. So we basically are going to have to discount it. Because you see, we have this now, we can make this, we can say, let's say the value, the combined company, with the project, the luxury project. Okay. So what we are looking at here is that what is going to be the value of this company if there's a project. And there are two scenarios. If the project grows in the first year, we are not going to sell it. Because what is the NPV, or the present value of the proceeds from Lumi if we sell? Remember, it's going to be giving us 50 million, but at the beginning of year 2, which means we need to discount it. So we can multiply it by 1 plus, what was the rate? 12%. Power minus 1. So it becomes 44.7. Okay, these are 44.7 millions. So at the beginning of year 2, that's how much they'll give us in present value terms. Therefore, if the project doesn't grow as expected, remember, we are going to be getting 32 million for the 4 years if the project is not going to grow as expected. So it's better that we sell 44.7 and get a benefit, right?
Yeah.
Yeah. So now it means that you can also have that figure, the gain that we will get if we sell, so that we now are able to determine the expected present value. But now considering that when the project does not grow, that chance of 25%, now we don't continue the project, we sell it. So how we are going to do it, we are going to copy this, because I want to not repeat this, but the way I've copied it, I think I'm going to have to repeat it. Okay, let me just copy it. So if I copy it without having to, okay, so it's still referencing the sales. Now what we are going to do about it is that, of course, the second part here of when the project it grows in the first year, we are not going to bother with it. It's going to stay the same. But this part of when it doesn't grow, okay, so what we are going to do is that we are going to consider what we have got in the first year, then plus the 44.7, right? So, because we are going to sell it and not get the remaining amounts. So what we get in the first year is going to be what? So this is what we are going to change. So let me first put it like that. So what we are going to do is that in the first year, remember, we get 50% of the present value. So of the first, that present value. Then we add this 44.7 million. Are we working in thousands that side? Yeah. So this 44.7 is in millions, so we should divide it by, we should multiply it by 1,000. See the problem with the having to change accuracy. Let me maybe just change this one to thousands also. So 44.7, let's say 50,000. That the figure comes in what? In thousands. Then I don't have to change it from here, because now what we are doing here is we are saying the chance of that there's no growth in the first year, we are going to actually get the 50% of the cash flow from year one. That's what they said was going to happen if there is no growth as anticipated. But instead of now continuing with year 2 to 4, we are going to actually sell the project at 50 million. And the NPV, the present value of that cash flow is 44.6 million. So we shall add it here. Instead of going through with the other thing of saying, okay, let's sell. So that becomes 56,162. So it changes a little bit. And the expected net present value is going to be, again, I think it may have changed. Because to do this, what we said, we said, oh, okay, no, it's still okay. So it becomes 14.16. So this is, remember what we had got before was 10, and now we are getting 14. So therefore, now remember there's that question we had in the scenario where they are saying that considering whether having this choice would add the value of the project. And we see that it does. Because without it, the expected net NPV is 10 million, but with it, it becomes 14. Okay. Having the option to sell after 1 year, after year one, adds to the value of the project. Because you said, because before it was 10 million NPV for that project, but now it's 14. So there's an extra value of about 3 point something. And that's it for the calculations. Okay.
AFM is hard.
I agree with you on that part, but it is possible. There was even, I don't know if you saw it, there is somebody who got 100 in it.
I saw it. I said, for that, what sort of brain service?
Yeah. So
I think they remarked that one like 20 times.
Yeah. But it's you know, the way you pass this paper is the concepts. Now, if you look at the concepts that we've done today and yesterday, there are some that are overlapping. So if you keep on practicing those questions, now, like for me, the people who succeeded, they told me what made them pass. You see that I have many videos that I've been doing over the time because of the different classes. So they watched all of them and they did all those questions again by themselves. So when you do that, you basically have information that you retain that can help you cross over. Yeah. So now we should go to the solution to tackle the theory parts. Let me open the solution. Okay. So now the first part of this question, if you remember, was asking us to discuss whether or not the acquisition strategies of pursuing risk diversification and purchasing undervalued companies can be valid. And we talked about it. Yes?
That last computation? it says evaluate report that evaluates the benefit attributable to AFM and Fugae company from combining the two companies with and without the project which we did, and concludes whether or not the acquisition is beneficial. Oh, so after the conclusion, this last part, you have to give a conclusion.
Yes, and that one we do it there in the Word document, as we are going to see how they are dealing with it.
Okay.
Because these appendices are just for reference. Then you go and that side is where you're going to make your points for the assumptions and also this conclusion.
Okay.
Yeah. So the first part was asking whether it's okay for us to acquire companies that are undervalued and also doing diversification. And we talked about it. Just I want you to see how, of course, these people are writing so much you wouldn't expect yourself to do so, but it's for learning purposes. Okay, so and they're saying that diversification has been one of the reasons for doing mergers. If you have like individuals, if you are well diversified, the company also can benefit from that because it reduces the exposure to unsystematic risk. Also, there's a reduction in volatility of the cash flows, which may lead to better credit rating. Okay, so those are the advantages that I've listed.
What is unsystematic risk?
Okay. So you don't remember those two definitions of risks. You need to know them. There are two. We have systematic and unsystematic. So systematic risk is that risk systematic and unsystematic. Unsystematic risk is also called diversifiable risk. It is risk that is dependent on the nature of business somebody is operating or internal operations. That is unsystematic. So, for example, it can be because of the business you operate, also your internal operations. Like if you are hiring people who are well equipped with the knowledge and experience to deal with something, or you are dealing in a business which is so much risky, that is unsystematic risk. And it is diversifiable because if you feel like the risk is in this business line, you can add another business line to it that kind of opposes that risk. Okay, for example, like if during winter it becomes very cold, and therefore if you are in the business of selling ice cream, you will be making losses. But if now you also have a business that maybe does, like for example, road cleaning, where you remove the ice from the road, now that becomes profitable during that season. So because of the fact that those risks move in opposite directions, you have reduced that risk. So that during summer, when ice cream sales are now back, but the road cleaning thing now goes down. So they are moving in opposite direction. Then systematic risk, on the other hand, is a risk that affects all industries. Usually it can be because there has been inflation. But when there's inflation, it's not just one industry that is affected, all of them are. So that is not diversifiable. So when you diversify your portfolio, you remove unsystematic risk, but this one remains. And this one which remains is the one that we measure using beta equity. That one. So those are the advantages that they are saying for those kinds of diversification. But the problem is that investors can do this by themselves, okay, and even cheaper and even quickly. So that's why that's why we say that that's why they don't see why you should be doing it for themselves. Okay, so but it has beneficials. It has benefits doing that kind of undertaking. which we may be because it has the sovereign fund has the investment holding company and not well diversified itself. So remember, this company is held by the government. And maybe this government is not very diversified, so it may benefit from this diversification. So you can make that argument. Now, the other thing was about the undervalued companies. If you can identify the undervalued company, then you can bring the figure up. We talked about this. However, for you to work, you must have a superior capacity to identify those companies. Okay, because if they are there, that means everyone is looking for them. You need to be able to access information better and analyze it quicker, and also have finances ready for you to benefit from that. So that's the second point. Have the money ready, because by the time you realize the company is undervalued, other people have also done so, and therefore they are coming. But also you should set a maximum ceiling, how much you are willing to pay. Because like you saw in this example, they told us that they want you to give them 30% premium.
Yeah.
So if that's on the high, then you won't benefit, because all the synergies that, okay, in this case the synergies remained, but some situations you may calculate and find out that after you pay the premium, the synergies are all wiped out, and therefore there's no benefit in you actually acquiring that company. So those points we made them, although these people kind of blew it here by putting them as bullet points and all, at least you know how to deal with that question. So the reason why we are looking at you reading the whole of this is that by the time you finish reading it, you have got some knowledge, or at least you've got some questions to ask for to understand better that section. Then the report, as usual, starts with the that part of the summarization, the introduction. So it evaluates whether it is beneficial to acquire Fugae. It looks at the values separately, and then it looks at the combined company. Then it considers how much shall gain from the value created. Then the assumptions are also listed. Okay, then now they start. So they're saying that if you look at the two companies, the value is 451 million, and some of it you pay it via premium at 30%. Then the remaining part, 174, is what goes to the shareholders. And they have said that is an increase of 1.46%, because the share value was 12 billion and they get another 174 million. So they calculate the percentage here. When if you didn't calculate it, you still have this absolute figure, which is okay. Then Appendix 2 shows that accepting the project will increase the Fugae's value because the expected net present value is positive. And after taking into account the offer, the value actually becomes higher. Therefore, it is beneficial to take on the project and accept Lumi's offer if the industry does not grow as expected in the first year. So you see how they are summarizing it very fast without having to go so much into detail.
Yeah.
Then they go to the assumptions. Of course, assumptions that we do with this are usually, the first thing is that we are assuming that all of the figures that we are using are accurate, because they are estimates. Okay, and that's where I normally bring sensitivity analysis, so that you make sure that, because we are not certain about those accuracies, then we need to do sensitivity analysis so that we are able to see if things move, what is the effect. Also, we have used the RB model to provide an estimate of the growth rate. Okay, so now this is where you say the model that you used. And it's not unreasonable. You don't have to say that, although that gives you some marks for business acumen, because we are using the model that has been You can even give if you had time, you would say why you are using that growth model. Because we assume that whatever is retained is reinvested and therefore keeps the company growing. Also, we are assuming that the capital structure will not change after the project is taken on. That's why we are still using the equity debt ratios of the combined company to be the ones for the Fugae. Okay. In actual sense, when you have an acquisition, the capital structure changes because that company has its own debt and its own equity. So when they come together, the structure will change. But now this is where you come and explain why you are assuming that. Because the project is smaller than the value of Fugae itself, it is not unreasonable to assume so. Because remember, I showed you that Fugae, okay, Fugae is, okay, the acquisition, you see Fugae is 670 million, and they are going to invest, how much was it? Is it 70? 50 million. Is it 50 million? The luxury thing? 42 million, right?
Yes.
Considering the size of the company to this investment, that is reasonable to assume that it won't change. Also, if you look at the acquisition itself, AFM is very big. So acquiring a small company, the structure also may not change as much. So
Hello? Hello?
then,
You went silent. I wasn't hearing
yes,
you. I wasn't hearing you for some time.
hello, you can, I wonder when. But anyway, I was just showing you the sizes, the relative sizes of the projects may not change the capital structure so much. So, yeah. Also, they gave the outcomes occurring, probabilities of them resulting in those cash flows, and they are giving them with certainty, like as if they can be able to know the probabilities, but it's not easy to know the probabilities. Okay, so we may not know them with such certainty. So the best way to deal with this is to have used the Black-Scholes options pricing model. When you did the question starting, I told you about it because when I was reading, I saw as if they were giving us enough to deal with it, but they didn't give us enough. Because if you look at the formula for the Black-Scholes model, you need to have a lot of information. You need to know PA, which is the exercise price. You need to know D1, which can calculate if you know PA and PE. But mostly you needed to know the standard deviation, the S, okay, and also the time horizon, which that one we knew after 1 year. But we didn't have enough information to do this. So that's why they have said here that it would have been a better alternative to get a more accurate way of assessing the value. And also, since these people are going to pay us 50 million after 1 year, remember we are only going to sell if the tourism industry does not grow after the first year. So there is also a risk that if it doesn't grow, this guy may also say, okay, me, I also don't want to buy. So we need to make sure that there has been some contracts that are drawn down so that these people can't back out.
Yeah, okay? Despite not growing.
Yes. And then, of course, now they conclude that although they'll gain more from acquisition, both companies are going to benefit. If we take on the project, although it's value neutral to the acquisition, you can ask for additional 30% to be transferred to it, which is 3.7. Hence, the return will reduce by a small amount, but not significantly. So they are saying that if the other project of the luxury transport, because since before we said that they are going to give us 30% premium, they may ask this value that we are getting from that side to transfer 30% also. So, but this one you don't have to really mention it. You just the conclusion. Usually, the conclusion is going to be scored. There is not going to be a chance that you conclude and you don't get scored for it, because what you are doing is just summarizing what you have already calculated up. Okay, as long as the parties are satisfied with the values, it would appear that the acquisition should proceed. This is very important because remember the question asked you to advise whether the acquisition should be said in the words, it said acquisition is beneficial. Okay, so that's where now the conclusion has put it as acquisition should proceed. And then, of course, you now the appendices are in your Excel, and now you have finished the question. So it requires you to relook at this question by yourself so that you know whether you are able to reach some of these figures. Okay, so that can give you some kind of, it may maybe give you some kind of confidence so that you can be able to do these other questions as you go through.
That part of GRing, I was like, why are we been going?
Yeah, the cost of capital, it's called gearing and gearing, that one. Even your colleague that you sent me had said, I think she has issues with that gearing and gearing part.
I'm even starting to think I missed a lecture. Maybe it was among
because you don't seem to remember.
I don't at all. And I was talking to someone today, and they were just giving me tips about AFM. They did it sometime, and they were like, they mentioned that thing of gearing and gearing. So when you were talking about it, I was paying attention, and I said, I need to understand this concept.
The best way to do it is to maybe first go for the lecture, but if you don't get it from there very well, you can now go to the textbook so that you read that section, because it is important. If you are lucky, okay, and I'm saying this because there are many other difficult questions that can come, and me personally, I would hope that that number of gearing and gearing is what comes for your section A, because if you learn how to do it, you can always pass it.
Yeah, okay.
Yeah. So I don't know if you have any more questions.
No, not for now.
Okay. Okay. So you just keep on going. Those concepts are going to start cementing, and then you'll be able to do a question. So I'll upload this video along with maybe other videos, but I don't want to first put the others for now. Yeah. I'll just put as we go, then I'll now put all of them at once at some point so that you have some marathon through them.
Sure. Otherwise, this paper can discourage you. But let me not discourage. It's okay.
Don't discourage yourself before you do the paper.
Oh man, yeah. When I start practice, I'm sure my confidence will grow.
Yeah. All right. Have a good night.
Good night. Thank you so much.
You're welcome. See you on Monday.
All right.